Hello and welcome to KYC. I am Sharad Dubey and the company on KYC's radar today is a City Union Bank. Of course, a lot of concerns are there and the questions also is why we have taken this company at KYC. First and foremost, there are some questions to be known. Of course, the first thing is for City Union Bank is overall how the operational parameters are actually panning out. If you could just show why they have got these companies, MSME, SME, retail, agri segment. Which of these sectors will be driving the growth? That's the first question we will be asking. The second question, of course, is that the factors that will aid the lower credit costs, the margin outlook going ahead. So overall, the banking space is seeing lots of changes happening, and sometimes these factors are coming in a very positive manner. That means some growth is expected. What will be the outlook on the advances and deposit growth? That's very much important. One of the core parameters when we track a banking company. Also, an important question for City Union Bank would be that what's the branch mix and the expansion roadmap ahead? This company, remember, is largely concentrated in the south, especially Tamil Nadu. So that will be very interesting commentary which will come from the management as how their expansion will pan out. Apart from this also, we see that one more important question is there that the company itself has been incorporated in 1904 in Tamil Nadu. So to put that in perspective, it's a very, very old public sector bank, and we had teased earlier with you when we were doing a guess your company round. Also, it's one of the oldest private sector banks in India. And moving ahead, looking at this operational part, 889 branches are there nationwide. That's a very important number and a strong presence in South India. In this also, if you look at it, there are roughly 557 branches in Tamil Nadu out of the total 889 branches. Looking at the branch mix, largely it is dispersed equally, and that's actually a very healthy thing for a bank of its size. Rural is around 177 branches, metro roughly 206, urban 218, and semi-urban, you look at it, that's coming at of roughly 288 branches. Loan mix, which is coming on your screen, these include MSME is roughly 40% and the agriculture part is also there, that's roughly 16%, and lower numbers coming in the non-agri and the other segment. This is the total loan mix breakup coming in. If you look at the sector wise, that's on the lower side, commercial real estate, housing, NBFCs and personal loan, and these are the areas where the growth is also on the higher side, and management might be focusing in these areas as well in the future. Also, this is the entire setup of the Know Your Company going ahead, and we have given you the overall about the company as well. But let's focus actually on the ratings for this company, and before that, the parameters which we set in, that's very much important when we get a company in KYC. There are 8 parameters for your reference. This includes income statement, balance sheet, operational metric, and even asset quality. Now, these 4 parameters which I just discussed, this is for a banking company. So we have tweaked the format a bit since the banking reporting is very different. Shareholding, it's largely the same as we do usually. Street cred, you can say the stock price movement going ahead, and also valuations and street coverage. That is something which we will be looking out for. But let's move ahead now about the company and deal with the overall numbers, how it actually pans out. The first one is the income statement. Over here we see the net interest income, that's a 8.2% growth coming in. And apart from that, if you look at the operational profit, not much happening, but the provisions, that is decent at 12.7% decrease coming in, and when provisions come down, it's generally good for a company. Profit has been very healthy, that's around 24% of growth coming in, and interestingly, if you look at these numbers, they are on a neutral aspect as well. The numbers also in the H1 numbers, the Q2 numbers, they were also pretty decent. And that's why overall net I will still give a neutral rating because of a good up move coming in the profit levels. The second parameter is also very much important, and that is the balance sheet. Net overall, looking at the initial numbers, and these are operational metrics also to make it simplified for you. Advances and deposits 3-year CAGR, they are between 9 to 10%. Largely the industry is coming in at 11 to 12%. So net it's almost equal to what the industry is expecting. But let's go down. CASA, that number is look at it, that's around 12% growth coming in going ahead, and even the capital adequacy ratio, that's also decent coming in at 20% odd. So net Not much great parameters, but not bad as well. So I would be giving a neutral rating. So till now we have given the income statement and balance sheet, both of them neutral rating. But now let's look at the operational metrics. Now this is the third metric, and this is a special metric for a banking I have got for you. And this is regarding the cost of deposits and even the loan yield. That's where the divergence starts coming in. The cost of deposits, that has actually kind of gone down, but the loan yield, that is also gone down a bit if you compare the FY25 to Q2 FY26 as well. So there is a divergence trends. NIMS, there is also kind of a pressure. FY22 it was roughly 4% and now it's at 3.6%. And majority of the banks, if you had heard the con call, they had stated that these NIMS would be bottoming out going ahead. So that is something which the street as well as the investors for City Union Bank will be hoping that this reverses as well. Cost to income, that has been at 49% on the higher side coming in, but the strong case of scenario is for the return on assets. Look at that growth coming in from 1.35% in FY22. It has been growing steadily in FY25. It was 1.55, and H1 FY26 or Q2 FY26, you can take it, it's 1.57%. So on the higher side when it comes to the return on assets. And the NIMS, that's what the street is expecting, that it bottoms out, but there is clear divergence you can see on the screen when it comes to the loan yield and cost of deposits. So net, I would be giving this operational parameter still a thumbs down because it's not stable yet. Now, speaking of stability, asset quality is one of the most important things to check for a bank, whether the GNPAs or the NNPA ratios are coming down or not. And when that happens, the overall liquidity ratios and the balance sheet ratios improve for a bank whenever we judge a company. So looking at City Union Bank, there are two important metrics to judge. One is the GNPAs and the NNPAs. Look at that, a significant improvement. In FY23, this number was roughly at 4.4%. But bank has been taking some good steps. NPAs are also reducing, and because of that, you see FY24, it was just 4%. After that, it's coming in at almost 3.1%. So there's a significant kind of improvement when it comes to the asset quality. It is stable as well as improving, and these are the both words you should note down. NNPA also, the story remains the same. Look at that, from 2.4% it's down 1.3% right now, and that is where maybe the company might be commanding a significant valuation. Also, the buzz in the street is about the expected mergers in the public sector bank, and that has driven the PSU bank's rally. And earlier itself I had stated you also that this would be the best Q3 in terms of stock price movement in the last 18 years. So net asset quality, I will be giving a thumbs up for this company. Now let's move on to the shareholding. That's also pretty interesting. And look at how FIs have moved around. It's around 26%. So it is stable. From March 25, it was 28%, then it came down to 26%, but very stable. But DIs, look at the lapping which has happened. And DIs are 33% in the March 2025. That a significant jump. In 6 months, they have increased their stake by almost 4%. So 37% holding comes in for DIs. But on the other hand, retail has taken some money off the table from 39% to 37%. But net, it is very healthy that DI absorption is much better than selling of the retail, while FIs remain very stable as it is over the last 2.5 to 3 odd years. So for this counter, for this rating, I will be giving a thumbs up for City Union Bank. Apart from shareholding, let's move on to the street cred. And has the company actually disappointed anyone? I don't think so when it comes to the 1-year shareholding or even 1 month shareholding pattern. Just look at it, 19% growth coming in 6 months, 42% growth, and year-to-date basis, the stock has given 60% return. Remember, the markets had a very testing patience when it comes to the benchmark indices and even your large private banks. But look at the growth City Union Bank has given, that is phenomenal. And because of this, overall, I will be giving the stock a strong thumbs up when it comes to the street cred. And interestingly, October, November, December, the third quarter which I call, this is the strongest up move in 18 years. So net, it is, you could say, I would be giving a neutral, of course, sorry, I'm just changing that thing. It's actually neutral coming in because the 5-year performances, that data has not come in yet, and it will be hard to judge the company on that. Moving on to the valuations front, valuations is nothing more because stock has increased a lot. A significant up move has happened. let's just compare them with its other peers. JK Bank is below 1 when it comes to the price to book ratio. Karnataka Bank remains the same story. Let's just compare it with the higher valuation companies. IDFC First is at 1.6, so is CSB Bank. But City Union Bank, this is a clear outlier, 2.21 times its price to book ratio. So is there any steam left in the stock? That's the question. Valuations are on the higher side as well. Has the street baked in all the positive news flows for the company? What else lies ahead? So these are the questions we will be asking the management as well. But net right now, it would be a thumbs down when it comes to the valuation comparison. So we have till now done 7 ratings, and over here we have given the judgments of this company, and the last one but not the least is your street performance, your street coverage, how it actually pans out, how much analysts are tracking the stock, what are their views. And on the screen we'll find the total recommendation calls. There are totally 30 analysts who are tracking the stock, and 27, that means 90% of them still have a buy call. Only 10% have a sell call, and the average downside is roughly 4% because there was a significant rally in the stock itself. So it would be a neutral rating when it comes to giving the numbers for the company. But now let's look at the final performance of the company, how it has actually panned out, and there are rating parameters which I would like to revise for you so that you understand that the entire analysis which we did over the last 10 minutes or so, what is the actual summary for it. Income statement, balance sheet, it has been largely neutral, but the pressure is still there in a couple of operational metrics, and that's why a downtick coming in here. But asset quality has seen a significant improvement, and not only City Union Bank, this has been seen across the public sector banks. So right now it's even Stevens. Shareholding has been good because of the support coming in from the DIs. Street cred, very strong October, November, December numbers, but long-term basis, the rates, of course, there are some questions to be asked. Valuations not favorable at all. If you have a banking company which is almost 2.2 times its price to book ratio, and last but not the least is the street coverage. Still analysts are bullish, but not much return potential left. So net, if I combine all the 8 rating parameters, I will be giving the company 4 out of 8 in the KYC final rating. So that means at an average wise, this is just an average rating for the bank. But is the commentary of the management average, or is there something important in store for that? Let's just get into the management, and we are joined by Dr. Kamakodi. He's the MD and CEO at City Union Bank. A very good afternoon to you, Dr. Kamakodi. The first question I would be asking is the NIMs bottoming out. Most of your peers have stated that the NIMs would be bottoming out going ahead. Over here, decent NIMs are there, but as the say goes, dil mange more, the market mange more. So the question is NIMs. What's the outlook going ahead for that?
See, the one item which I want to talk about our bank in terms of all the parameters is the consistency, for which, like say, the whatever premium what market is preparing almost over a period of time, except briefly, is the consistency. So we had about 3.5 to 3.6 percentage in NIM at the beginning of the year. We told we will be having about plus or minus 10% for the current year. And as the rate reduction cycle happened quickly, particularly with the 50 basis point front loader.
And we will be asking the management in some time, the MSME, SME, retail, agri segment, where the growth is actually coming in. And we could say that overall the markets, how it's actually looking like, we will see that some segments are outperforming the others. But coming back to Mr. Kamakodi, sir, if you could just explain us that NIMs are stabilizing since the last time we spoke, and just give me the date. Is it going to be the 3rd quarter or the 4th quarter where we can see the signs of NIM stabilization?
Already you had started seeing that in the 2nd quarter itself better than what we anticipated. And we expect the 3rd quarter and 4th quarter to be even slightly better than whatever we saw in the 2nd quarter. And the stabilization has already happened.
And the stability has happened, but let's move on to the sectors where the performances is something which we are looking at. There is MSME, there is SME, there is retail, there is agri. These all 4 segments are there. Which of them will be driving the growth?
The growth will be by and large stable across all the sectors. And as you might have seen over the past 3-4 quarters, Earlier, we had not ventured too much into the consumption retail, particularly the housing loans, or even our focus was more purely on the MSME, agriculture, commercial trading, both wholesale and retail, and also the gold loans. Now we, like say, started about 2-3 quarters back with retail loans, including the housing loans and all. And in fact, we told after we went for the digitalization of our LOS and all in the last year, we told we upfront about 25-30 crore expenses in the last year, and this year for the financial year 25-26, we will be breaking even on that, and from the 26-27 onwards, it will start adding to the profitability and all. That is one extra segment where we ventured into from the last year, which is also giving us some tailwinds on our growth rate. You might have already seen we surpassed our anticipated growth rate in the Q2. And we always we used to keep a target of about 2 to 3% over and above the growth rate of the industry. And last quarter, we slightly we were ahead of that expectation, whatever we shared. And that was mainly because of that extra push which happened because of the growth in the retail segment, housing loans and things like that. And those things are very much in our side so far.
All right, Mr. Kamakodi, another question is, of course, this is regarding the industry, and the buzz in the street is, of course, there that the public sector banks, they are seeing candidates for being in a merger. Now, any kind of update coming in from your side on that?
See, I have been facing this question almost for the last 20 years, and we are giving the same answers again and again. Our bank believes in growing in an organic way, in a slow and steady fashion. As we had been repeatedly saying, we are test match players, and being a decrease itself will make us score runs in our own pace, and we are not 2020 players. In that way, if you look into we believe in growing in an organic way. And in fact, the branch opening and all are also happening in a faster pace. We used to open about 75 branches every year. This year also we are on track, and we have completed our opening of 900th branch last week. So overall, our focus is to maintain the identity, grow about couple of 2 to 3 percentage point over and above that of the industry, and maintain the identity on an ongoing basis is the focus with which our bank is moving forward.
Mr. Kamakodi, you spoke about the expansion plan going ahead, but if you could just give us the breakup of the branch mix, what's going to happen? Will we have some more expansion plans coming in from the non-south areas? If yes, can you just quantify that?
We had always shared this plan with the market, particularly through our quarterly con calls and all, and the information is already in the public domain. By and large, we had, exhausted Tamil Nadu. So incrementally, not less than, except the unbanked rural part, in the remaining, you have to open statutorily about 1/4 of your new branches in the unbanked rural. In the remaining part, majority of them will be in non-Tamil Nadu. To start with, definitely there will be focus in both South and Western India, like Maharashtra, Gujarat, Rajasthan and all, where we had almost, close to over 20 branches or so, which got opened in the last, in each state in the last 3-4 years. So that momentum will continue.
Okay, that means the expansion is coming in for Maharashtra and Gujarat when it comes to the non-south markets. Mr. Kamakodi, another important question is, there is any sign of visibility of recoveries that could support lower credit costs, and what would be your views on that?
Absolutely. Even for the 30th September results, you might have observed, over the last 6-7 quarters, the recovery of NPAs had surpassed the slippages. And there is a continuous firm downward revision of, reduction in the addition of NPA to the tune of not less than 100 crore every year over the period of last 2-3 years. and our net NPA has come below 1% after almost a decade or so. Before COVID, like say we wanted to have our net NPA 1% plus, but it increased to close to 3% during the COVID. But firmly and steadily, it has come down below, like say 2%, like say 1% in the last quarter, perhaps for the first time in the last 10 years. And we are able to see that in terms of slippages, things are much better, and also we are able to see much bigger reduction in the like say overdue accounts, particularly the special mentioned accounts in total has come down from double digit, like say about
And
6 quarters
Mr.
back.
Kamakodi, important
Yeah.
question, which is operational question, and after that there will be a question on the RBI as well. The first question is, what's your outlook for the advances in the deposits growth? Because the industry has been going in at 11 to 12 odd percent. The CAGR, which I am seeing, it's quite close. It's not very industry beating, but it's near the industry levels. Will we see some increase in these numbers or some kind of plateau movement expected in third or fourth quarter?
We had always maintained that we will be growing at about 2 to 3% over and above the growth rate of the industry. The record which we had shown consistently over the period of last about 15 years or so, except 2-3 years in between post-COVID. So we hope to maintain the same only. We are not aggressive player in going for the extra growth and all. Safe and steady play is always our forte, and we would like to maintain that. And maybe last quarter and all, we had 1 or 2% extra, even over and above that 3%, mainly because of like firming up of growth from the like say secured retail, which had not been there for us in the past.
All right. Thank you very much, Mr. Kamakodi, to giving your views on that. This was, of course, your company perception and the outlook going ahead, and what City Union Bank has done and why it actually deserves the premium valuations against its peers. All answers we have got you in our show, Know Your Company. But to revise what the management had stated, this is the most important thing. NIMs are expected to be better in the third quarter as well as fourth quarter as compared to Q2. Already the signs of stability have come in the second quarter as well. Let's pull out the second important management takeaway which has come in, that is that the growth will be stable across all the assets, SME, Agri, and the rate cut transmission is also happening. That means this will be beneficial to all. Also, the last statement is also very, very much important, and I asked them the question, where will you expand if not south? They have given two important regions, Maharashtra and Gujarat, where the City Union Bank growth would be coming in. So these are the important management takeaways which we have done at KYC. But net, maybe the company might command premium valuations as they're expecting a stronger Q3 and Q4 as well. That's all for today. Stay tuned to Know Your Company.